Hi traders, in today's video I will talk about the MFI indicator. Now, as I already know, you really like oscillators, as I do too, because oscillators are a great additional tool to a forex trading strategy alongside with moving averages and price action patterns. So they are just one of the best way to analyze the markets and find divergences and just find how the market reacts at the moment. And now I want to talk about MFI, the Money Flow Index Indicator, because I know that most of you really like RSI indicator, and most of you just only know the RSI indicator, and therefore I realized that I want to talk about some other oscillators as well that are not that well known by beginner traders and advanced traders as well, because it is not that commonly used indicator. So what is MFI and why it is so different in a way than RSI? As you see, here is a gold US dollar chart, because I just want to show you how it can be used in a good way and why, of course, as an oscillator it can't be used by itself. It is just how it is. So the money flow index indicator is really similar to RSI, but, and here is the key, the RSI indicator doesn't include the volume data, but the MFI indicator does. And it is really important that the RSI indicator can be, in my opinion, it can't be really used to find divergences, but the MFI indicator is really good to do that. And here is a point that I just want to warn you that, of course, it can't be always used to find those spots. Now I want to tell to you what does it mean. Divergence means that when the price moves in a certain direction and the oscillator moves in a different direction. For example, here it is not the case, because the price moves downside and the indicator moves downside, and here the indicator moves to the upside and you know, the price moves to the upside. So here it is not the case, but of course there are times when it is the case, and then we can identify a reversal of the current trend. And that is a really powerful thing to do, and this is why this indicator is really commonly used by pullback and reversal traders. So I have to tell you that, of course, the limitation of this indicator is that it is not always the case that you can actually, it is not always the case that you can spot the reversal with this kind of method, and most of the time you won't spot it. And the indicator is used by many reversal traders, and they use it just like RSI. So here is, for example, there are many use of this and how traders use it, but the most common is the two lines that you can see here. It is the 80 and the 20 line. And when the indicator hits above 80, it's considered as an overbought. The market is overbought, and when it hits below 20, it is considered as oversold. And this is the two. This is the most common way to use this indicator. Now, in my opinion, if you want to use it this way, of course, use one or two more indicators and not just oscillators to confirm that it is a reversal, and make sure that your money management is good and actually are using 1 to 2 risk to reward ratio at a minimum. And additionally, I would recommend to use not to 20 and 80, but I would recommend to use 10. So somewhere, a moment, somewhere here. So 10, basically, that is, in my opinion, much better. And 90, that is, I'm not sure if it here it hits that number, but here it does. Yeah, it's not here, but here it does. And I would recommend to use those numbers because there are too many false signals if you are just using 80. It is just too soon when it realizes these situations. And I would either recommend to use 95 somewhere, or you know, or just 5 when it is in an oversold territory, or you can use it in a different way, that for example, you take a trade, of course, with the confirmation indicators when it crosses the 50 line from above or below. So you can use it in multiple ways, and I recommend to play around with the period of as well, because the default periods are not very good most of the time, and you can create much better strategies, and you can actually see the price in a just a clearer way, actually, if you are using not the default numbers, the periods for indicators. So this is really important in my opinion. Now I want to tell you the equation of this indicator, because in my opinion, to know the equation of a certain indicator is always really useful. And I know that many traders don't understand why, because here is my computer. Why would I want to know the equation on paper? But the thing is that you will understand the market so much better if you know the real if you know the real equation, and not just so if you are just clicking and you're just clicking on indicators, and you won't have a deeper understanding of these kind of things. It is just how it works. So the equation is that the money flow index equals 100 minus 100 per 1 plus the money flow ratio. Now you would ask, what is the money flow ratio? What is that? And the money flow ratio is basically the 14 period positive money flow divided by the 14 period negative money flow. So what is the money flow? The money flow is basically the typical price, and it is multiplied by the volume. And I guess you already know what is the typical price, because it is taught in schools and stuff, and it is just a basic thing, like average. But I tell you because you might don't know it, so why not? So the typical price is basically the high plus low plus close, and it is divided by 3. So this is how it works, and how it calculates itself. And I hope you enjoyed this video. It was a really I hope you enjoyed this video, because it is just so good to explore new indicators and not always using this RSI and MACD and the basic indicators, and just get to know some new ones. Ciao.